Coming up in today's show, the housing market takes a turn for the worse. Investors pour $45 billion in the stock market in June, a record for over a year. 4 bearish scenarios that could rock the stock market by the end of the year. The price of wheat rips on more Russian aggression. Apple jumps on the AI train. Tesla's Q2 earnings jump 45% year over year. Netflix sees huge subscriber growth. Carvana stock rips 40%. And AT&T and Verizon bounce back hard. Hey, what's up guys? My name's Jared, and if you're new to this channel, welcome. I make these videos every day after market close, going through the most important news, data, and charts of the day to keep you updated on everything that's happening in the markets. So hit that subscribe button if you haven't already, and these videos will show up on your YouTube home screen every day. Okay, so today in the market we had a little bit of a reversal of the trend we've been seeing of late, with mega cap tech pulling back a bit here today, and a bit of strength in the healthcare, utilities, and consumer defensive sector. We're starting to get in the thick of Q2 earnings season, so we're seeing a bit of dispersion in the market, with blotches of red and green over the place as we get different numbers and guidance from all the major companies. And so the big one today, of course, was Tesla coming in with a pretty good beat on the top and bottom line, reporting Q2 revenue of just under $25 billion, almost $500 million more than what analysts had expected, and earnings per share coming in at 91 cents compared to estimates of 81 cents. That's a slight gain from Q1 and a huge 45% gain from a year ago. The Q2 gross margin came in a little weaker though at 18.2% versus expectations at 18.8%, and that's largely due to their price cuts on their cars this year, which overall has helped them crank out the sales and still gives them well above industry average gross profit margin. And the biggest story out of Tesla this year will be the Cybertruck. They just released their first production of the Cybertruck out of Austin, Texas last week, and we'll be looking for more news exactly when that's going to be able to be purchased, possibly later on this year. And this should prove to be another popular product line for them and just keep adding another tailwind to their revenue and profits. And just looking at the price action in Tesla today, we just almost got up to 300 a share in regular hours, and we're just selling off a little bit here after hours as I speak. It was initially a bit of a muted reaction, and right now as I speak we're just trading down to 280 a share. The other big one out today with earnings was Netflix. They came in with a huge surprise on subscriber growth, adding 5.9 million new subs in the second quarter of this year, way above estimates of 1.82 million. They came in with EPS of $3.29 a share compared with $3.20 a share the same quarter last year, and revenue was a bit better as well, 8.2 billion versus just under 8 last year. They also said we expect revenue growth will accelerate in the second half of this year as monetization grows from our most recent paid sharing launch, plus growth from their new ad-supported plan. And so while Netflix has been trending up really nicely this last couple of months, like Tesla, we're selling off pretty hard in the after hours here, getting down to 439 as I speak, down 8% in post-market trading. And so considering they beat EPS estimates by 15% and gave pretty good guidance and things seem upbeat, this is a pretty negative market reaction that we're seeing right now. And that's spilling over to the other mega cap techs as I speak. Apple down 0.5%, Microsoft down 0.5% as well, Google a little bit, Amazon as well, NVDA down 1%, and Meta down over 1.2%. We've got the rest of the mega cap techs reporting over the next week. And sometimes you can see this in the market, even when the companies come through with good numbers. Just the fact that these earnings come out can mark a time in the markets when shifts take place. And we can see that's affecting the NASDAQ overall after hours too, down 0.74%. So that's not a good start to the mega cap tech earnings with this negative reaction so far, even though we had good numbers come out of Tesla and Netflix. Also out with earnings today was United Airlines, which posted a record high quarterly earnings and lifted their full-year profit outlook. And they came through with a whopping 24% beat on EPS, and they're up just a little bit, 2.4% after hours. The other big mover today was Carvana, up over 40%, as the company came out with surprise news yesterday, bringing forward their earnings results by a month, and the market initially sold off thinking that was going to be something bad coming out. However, it's usually when companies delay their earning results that something bad's going to come out. They actually had good news that they're going to reduce their outstanding debt by 1.2 billion by restructuring their finances, and they actually topped revenue and profit expectations as well. And just looking at the chart here, this is a stock I've been talking about for the last month or so, with how much momentum it's been having and kind of how it got down so weak at the start of this year. It was kind of left for dead, priced to go bankrupt, and it's kind of jumped back from the grave with a huge amount of momentum and continuing to trade higher and after hours as I speak, now at 57 a share. And so this stock had been heavily shorted, and I think maybe the CEO and the board just wanted to squeeze those shorts before they were supposed to announce earnings next month. Two other stocks I've been following, AT&T and Verizon, have been significantly oversold and undervalued, had a really good pop today. after AT&T came back and pushed back against those worries over its potential liability for contamination from their lead-covered cables. And some analyst estimates have put the cost around 10 to 15 billion. However, there's a lot of different numbers out there. Some saying 35 billion, some saying 5 to 50 billion, some others saying 2 to 20 billion. However, the sector's already lost more than 30 billion in market cap just on the back of this news. And we can see that here in the price action today with AT&T up a huge 8.5% on massive volume, and Verizon as well, extending yesterday's gains up 5.2%. So it looks like our DSI indicator nailed this one, and back on this day as well when I said this was really oversold and undervalued. Over to economic data out today, and we had building permits come in with a bit of a surprise on the downside, falling 3.7% versus expectations of a 2.3% fall, and that was after a real bumper last month. Had a huge surprise to the upside, 5.6%. Same with housing starts month over month was a massive 15.7%, and that's declined 8% this month as well. So the housing market is volatile, and we've got this funny dynamic happening where over 90% of mortgages are locked in at those low rates we had a couple of years ago. And so most homeowners don't want to sell, and that's causing the market for brand new homes to boom. And we can see that in this chart here of new single family homes as a share of single family homes for sale just been rocketing this last couple of years higher. And that's showing up in the price action of the home builders ETF XHB, which has had a great year and been on a parabolic uptrend. It's one of the best performing sectors out there. However, the question is what happens when all those mortgages that had 1, 2, 3 year teaser rates, fixed rates for a couple of years, readjust to the market rate? We could see an influx of supply from those houses then coming onto the market in addition to all this new supply out there. And that's why some investment banks like Goldman's are saying get ready for a historic slowdown in home price growth. They expect prices to likely rise less than 2% this year and next, and less than 4% in 25 and 26. And right now the cost to buy a house with these high interest rates and mortgages significantly above the cost to rent, which also creates low yields for investors. And we can see that here with short-term US Treasury now giving a higher yield than the average cap rate on rental properties. And we don't know for sure that rates have topped out either. So the last time we had this big gap between the cost to buy a house and the cost to rent was back in 2007, and we all know what happened to the property market after that and going into the GFC. So right now in the housing market, everything's okay because the economy's holding up, everyone's got a job, most people are locked into low rates. However, when people have to start refinancing, and if rates keep going up, if the economy does take a turn at some point over the next year, we could see that really sharp reversion to the mean like we got back in 2008 into 2011. But right now, there's a strong blue sky outlook for stocks and risk assets as investors poured $45 billion into the stock market in June. On the back of inflation cooling, the jobs market holding up, and continued buzz and hype around the new AI theme. However, there's 4 bearish scenarios that could rock the stock market by the end of the year, highlighted by DataTrek. And they said stocks are priced for near perfection in what will always be an imperfect and unpredictable world. The first scenario is investors start to take profits, which always eventually happens after we have a strong rally. The second could be sticky inflation. The third could be a surprise slowdown in the jobs market. And the fourth could be if real interest rates continue to rise. But for now, the stock market is ignoring all those possibilities and pricing in a Goldilocks soft landing scenario. And whilst falling inflation is a good thing for the prospect of lower rates and lower bond yields to contend with, that can still be a headwind for stocks because falling prices takes away firms' pricing power, which hurts earnings. So that inflation we got out of COVID actually helped cause a rise in profits as companies could keep jacking their prices high, especially tech companies who didn't see huge increases in their costs since they're mostly on the cloud. And even though we've had a bit of a return to work from people working at home, we've still got US office vacancy rate rising to 13.1%, which is a new record high, and just continues to put pressure on the commercial real estate market and all that debt out there tied to it, which has to be refinanced as well at higher rates going into next year. And even though we've got record low unemployment rate, we're already seeing a tightening of credit in the economy, with borrowers getting rejected for loans at the highest rate in 5 years. Huge amount of 21.8% of applicants being rejected for credit, and that's been kicked off ever since those regional banks, including Silicon Valley Bank, failed. Banks have significantly tightened their lending standards, which is usually the starting point for more trouble in the economy and recessions as such, as the availability of credit has a big impact on the economy. Also out today, we've got JP Morgan saying de-dollarization risks aren't priced into the market, despite rising US dysfunction and tension with China. They said the dollar is very expensive in historical terms, suggesting that a narrative of secular dollar decline is not prevalent in the market. They said investors should underweight the dollar, as well as US markets, bonds, and equities. And just looking at the chart of the dollar index futures, we have had a bit of weakness this month. Looks like we've bounced just above 99 here. However, taking you out to a weekly chart, it looks like we are in a downtrend now, having lost that big support level just above 101. But in another mixed signal out there, typically a weaker dollar is good for risk markets like stocks and commodities as well, which have seen a nice bounce up this last couple of weeks. And a weaker dollar is good for gold bulls like myself, as there's only a finite amount of the shiny stuff out there, but there is an infinite amount of US dollars thanks to the Federal Reserve. So I continue to expect gold to break out to new all-time highs over the next couple of weeks. And that should also help keep a bid underneath the price of crude, which is currently just above $75 a barrel. And just looking at that weekly chart of crude, ever since we peaked out early last year, above 120 a barrel, we've been in a big steady downtrend. And that's helped inflation a lot come down, as crude's a big input into a lot of things, energy and industrial production. So if we were to continue to see crude tick up and break out towards $100 a barrel, that's going to put a lot of upward pressure on inflation. We've also got geopolitical tensions putting upward pressure on commodity prices as a whole, with more aggression out of Russia. Earlier this week, they launched missiles straight to the port of Odessa, one of Ukraine's key grain exporting hubs, who are one of the biggest grain producers in the world, so that has a big knock-on effect to the price of food around the world. And Russia also backed out of a deal that ensured safe passage for Ukraine exports into the Black Sea. So it looks like Putin's getting really desperate here and trying to shut down Ukraine's economy. And he's also said all ships coming into Ukraine are to be considered helping the Ukraine military and a fair game. And once again continues to keep ramping up the situation over there and continue driving the Russian economy down the toilet. After we got news yesterday from Microsoft releasing their new AI product and seeing a huge bump up in the stock, not wanting to miss out on all the hype of AI, is Apple jumping on board with their version of ChatGPT and developing a new chatbot. And just looking at the price action in Apple, we initially started doing what Microsoft did yesterday. I'll just take you down to a 5-minute chart. And so we can see here when the news came up, price rocked up initially over 2% to new all-time highs to a bit over $198 a share, but then sold off quickly and kind of stayed down there as well. And just back to the daily chart, kind of created a bit of an inverted hammer reversal candlestick here, but still too early to say whether that's a top or not. Microsoft as well put in a bit of a dark cloud cover candlestick formation and couldn't break out to new highs today after their news of a release of an AI product yesterday. Fed Fund Futures, same, we're still definitely getting a hike on Wednesday next week when the Fed meets, and just a 13.7% chance they'll hike again in September. Fear and Greed Index still stuck in the extreme greed zone. Another busy day in the options market for a Wednesday, just under 43 million contracts traded, and another huge 62% of them calls. Looking at the earnings calendar for tomorrow, we've got Taiwan Semi and a few healthcare names like Johnson & Johnson and Abbott Laboratories. Dark pool traders still pulling away from the market a little bit, and rock bottom interest from corporate insiders in buying stock up here as well. Okay, back into the charts, and another day, another new high in the S&P 500 as we continue to grind higher on this really low volatility. Nasdaq was flat today. You can see we're selling off after hours as I speak, and once again, breadth in the market is holding up with the Russell up almost 0.5%. International stock indices are doing a little bit of a catch up here on the TSX. FTSE as well had a great session overnight. The DAX coming back up to highs, Nikkei consolidating, coming up to resistance, and the China just sitting flat there. Slight little pop in the VIX today, up 3.3%, and a bit more of a pop in the volatility risk premium, the VIX over realized volatility. Maybe the market just starting to price in a little bit of volatility into earnings season and the Fed meeting next week. We've got bond volatility continue to track down now with the MOVE index at 107 and just coming down a bit relative to stock market volatility, but still overall really elevated historically speaking. Breadth continuing to do well with 83% of stocks above their 50-day average, and the amount of stocks making new highs still easily eclipsing the amount of stocks making new lows. A little bit of a pullback in the growth versus defensive sectors, and small caps coming up to multi-month highs versus large caps. Got the 2-year government bond yield just coiling up here at 476. And nice pop-up in TLT back above its 50-day VWAP. As Bitcoin continued to trade a little soft after rejecting off this big resistance level. And there's the price of wheat futures absolutely ripping today on the back of that news of Russia trying to shut down Ukraine's grain exports. Over to stock sectors, and pretty mixed out there today. Here's a quick look at our sector trends table indicator. You can still see there is mostly green out there across the board, with most sectors still above their 5-day moving average, and the weakest sector continuing to be utilities. The winner today was regional banks up 3.1% and breaking out to a new multi-month high, and looks like we may have put in a bottom down here in early mid-May. And for those that watch my channel every day, remember back on the 11th of May, I did a special and shared with you 10 banks that were trading below their net liquidation value. In other words, they were trading below what the value of their assets minus liabilities were, and still profitable, and a lot of them had their insiders buying as well. And they've all rocked up a lot here today, with some of them up a lot, 40-50% ever since I came out with that video, and many of them up more than 20-30% as well. And we've still got a lot of these regionals to report later this week and next week, and so far it looks like we may have put the bottom in for these regional banks, and the price action continues to look strong in them. Even though we had weak retail sales come out yesterday, it didn't stop the sector ETF ripping 2% higher today. And we've got semiconductors right at the top of this big resistance zone, kind of pulling back a bit here on volume. Just taking you out to a weekly chart, we're now back those late 2021 highs for semiconductors as a whole. And a little bit of a move into the defensives today with healthcare, staples, and utility finding a bit of a bid. There's BlackRock continuing to perform well, JP Morgan ticking up again, and just a quick look at mega cap tech stocks after hours, still coming off a little bit here. NVDA down over 1% and Tesla down about 4%. Overall, pretty good day in the meme space thanks to Carvana, which is still up 3.3% after hours. Another move up in Coinbase and Peloton. We had earnings out today from US Bancorp, and even though they missed by almost 20%, shares are up 6.4% as we continue to see strong price action across the board in the financials. Earnings out today from Las Vegas Sands, they beat by a little bit of a muted reaction from the market, just down 3% after hours. Goldman Sachs reported today as well, they missed by a little bit, but the market still sent shares higher. And some of the even most vulnerable regional bank names got a strong bid here today. PacWest up 11%, Western Alliance 7.7%, Zion's up 6.2%, and the big guys continuing to trade well. Bank of America after yesterday's earnings. Wells still ticking up, and Charles Schwab holding on to those gains from yesterday as well. We continue to be in overbought territory on our S&P 500 oscillator, showing the market is persistently overbought here. And just looking at global net liquidity, even though we got a bump up over the last 2 weeks, still a huge 800-point gap between where global liquidity says the S&P should be and where it is today. However, we've still got this strong, persistent momentum in the S&P 500, and as long as we stay above this 50-day VWAP, this rally could continue on. Although we are seeing a little weakness in the Nasdaq after hours here on the back of Tesla and Netflix earnings, even though they both came in with good numbers, that could potentially be a sign of things to come. We'll just have to wait for the rest of the pack to report earnings over the next week to see how they respond as well. And that's a wrap for today. Thanks very much for sticking with me. I'm always interested to hear your comments on the market. I reply to everyone, and I hope to see you all again tomorrow. Cheers.